Welcome to Talk Tickers.
Your shortcut to understanding key earnings calls.
Today, we're jumping into Berkley Corporation, big name in insurance.
Yep, their latest quarterly earnings just dropped.
And our mission, as always, is to cut through the noise, give you the core figures, the essential insights, no fluff.
Let's get straight to it then. Berkley, they kicked off 2025 with a really strong first quarter.
Strong how? Give us the headline numbers.
Okay, so net income hit $418 million. That works out to $14 per share.
And the return on equity, that's always a big one.
Impressive. Annualized return on beginning of year equity was 19.9%, almost 20%.
Wow, okay. Especially considering, well, the broader environment, right? We had those California wildfires,
Yes.
Significant industry event.
Exactly. Despite that significant catastrophe activity, they pulled off that ROE.
What about the operating earnings, the core business performance?
Also looked healthy. $45 million or $120.11 per share.
And the return there.
That yielded a 19.3% annualized return on beginning equity. So still very strong.
And the combined ratio, the key underwriting metric.
Calendar year combined ratio came in at 90.9%.
So nicely profitable on the underwriting side then? Below 100 is good.
Definitely. And if you strip out the catastrophe losses, the picture gets even better. Their current accident year combined ratio, excluding cats, was a very healthy 87.2%.
Okay, so let's talk about those cats. How big was the impact?
Those losses totaled $111 million. That added about 3.7 points to the loss ratio.
And mostly the California wildfires, you said.
Primarily, yes. It was definitely an above average quarter for catastrophes, industry-wide, really.
Got it. What about prior year reserves? Any big surprises there?
Actually, pretty minimal impact overall. Net favorable development was only about $1 million across all segments.
Oh, okay. How did that break down?
Well, there was about $11 million unfavorable in the insurance segment.
Okay.
But that was offset by $12 million favorable in the reinsurance and monoline excess part. So, yeah, basically a wash.
Interesting. Great. Let's dig deeper into the underwriting performance itself. That current accident year loss ratio ex cats, you said 87.2% for the combined. What about just the loss part?
The loss ratio part ex cats was 59.4%.
How does that compare to last year?
It's up slightly, about 30 basis points year over year.
Okay. Any reason given for that uptick?
They attributed it mainly to business mix, the types of risks they're writing.
Right. So maybe shifting towards lines that inherently carry a slightly higher loss ratio, but perhaps better margins elsewhere.
Could be, yeah. It suggests a strategic shift rather than just deteriorating performance in existing lines.
Makes sense. What about the other side of the combined ratio, the expenses?
Expense ratio looked really strong, 27.8%.
Wow, that's quite efficient.
It is. They benefited from record net premiums earned, hit $3 billion.
$3 billion earned, okay.
And there was also a non-recurring benefit, something related to compensation, that helped the number this quarter.
So maybe not quite sustainable at 27.8, but still good.
They seem confident it'll stay comfortably below 30% for the full year. That seems to be their target range.
Okay. And you mentioned record premiums earned. What about written premiums? The top line growth.
Also a record. Net premiums written were over $3.1 billion.
Solid growth. Where did it come from mainly?
The insurance segment was the main engine. Grew a robust 10.2%, reaching $2.7 billion.
And that was broad-based.
Yeah, they said growth across all lines. They did call out specifically strong performance in short tail lines like property and A&H.
Accident and health, right. How were property rates?
Healthy increases on the sort of standard non-cat exposed risks.
But the cat exposed stuff.
More competitive there, as you'd expect. More market players vying for that business.
Makes sense. Any other standouts in insurance?
They mentioned Berkley One, that's their private client business, showed strong growth and they were getting good rate achievement there too.
Okay, what about the other big segment, reinsurance and monoline excess?
Also hit a record, $439 million in net premiums written. That's up 8.2%.
And the drivers there?
Mainly property reinsurance and also excess workers' compensation.
But it wasn't all growth, was it? I thought I saw something about casualty.
You're right. That growth was partly offset by a decrease in casualty reinsurance, specifically professional liability reinsurance that was down quite a bit, over 25%.
Why the drop there? Market conditions.
Exactly. Market conditions, and they specifically mentioned their own disciplined underwriting. Seems they weren't willing to write business at the prevailing rate in that specific area.
It speaks to their discipline, I suppose. How's retention looking in the main insurance segment? Are they keeping clients?
Seems solid. Renewal retention holding strong around 80%.
That's pretty good.
But tying back to that professional liability point, They did mention increasing competition within insurance for lines like D&O, cyber.
Directors and officers.
Right, and also transactional liability. They really singled out transactional liability as being particularly competitive right now. Fierce pricing.
Yeah, I heard some commentary suggesting they weren't impressed with the pricing discipline there. Didn't they call it something like the stupid award?
Haha, yes, I believe that phrase was used.
Yeah.
Suggests they think some competitors are pricing that risk way too low.
Okay. Shifting to workers' comp, you mentioned growth in excess comp. What about their primary comp business?
The growth there is apparently coming from specialty comp. Think higher hazard industries where there's maybe less competition.
So niche plays.
Exactly. They noted that general wage inflation has been a bit of a tailwind for premiums.
Naturally, as payrolls go up.
Right. But they are keeping a very close eye on medical cost trends. That remains a big uncertainty, a big potential pressure point in workers' comp.
Always is. Anything else on the horizon impacting loss costs?
Well, something interesting they brought up was tariffs.
Tariffs. How does that impact insurance?
Think about the cost of repairs or replacements. Auto physical damage, parts might cost more. Property, building materials could increase. Even, they mentioned workers' comp, like the cost of pharmaceuticals.
Huh. That's a complex ripple effect. Are they quantifying it?
They said they're monitoring it closely, trying to figure out the potential impact. But it's still pretty fluid. It shows they're thinking ahead about potential cost pressures, though.
Definitely. So overall, on pricing across the board, what was the trend?
Overall pricing actually accelerated a bit in the quarter, up by about 60 basis points compared to the prior quarter's trend.
So still getting rate increases?
Yes, and they continue to focus on getting what they see as adequate rates, especially in areas like auto liability and umbrella coverage. Still pushing there.
Okay, let's switch gears to the investment side. How did that perform?
Very well. Net investment income saw a really significant jump, up 12.6% to $360 million.
What drove that increase?
Two main things. First, record net invested assets. They're now managing $30.7 billion.
Okay, bigger base.
And second, higher new money rates. As their fixed maturity portfolio grows and rolls over, they're reinvesting at better yields. Plus, they had strong operating cash flow feeding that portfolio $744 million in the quarter.
So more money, and that money is working harder.
Basically, yes. They also got a boost from higher investment fund income.
Which funds?
Particularly from transportation and financial services sectors. But there's a catch there.
Oh, what's that?
That income is reported on a one-quarter lag.
Ah, so the Q1 results reflect Q4 fund performance.
Exactly. And given the equity market volatility we saw more recently,
right, things got choppy.
They're actually anticipating lower investment fund income in the next quarter's results. So that tailwind might become a slight headwind temporarily.
Good context. How's the overall quality of the investment portfolio? Any concerns there?
No, looks very strong. Credit quality remains high. Average rating of AA, very conservative.
And the duration, how sensitive are they to interest rate swings?
Duration on the fixed maturity portfolio increased just slightly up to 2.7 years. So still relatively low sensitivity compared to some others.
Any impact from currencies?
Yeah, they had a foreign currency loss of $19 million. Said it was due to the US dollar weakening during the quarter.
Okay. One last thing on investments. What are they actually yielding now? And what are the reinvestment rates looking like? That gives a clue to future income.
Good question. The current book yield on their domestic portfolio is around 4.7%.
And new money, where can they reinvest?
Reinvestment opportunities are currently around 5.2%.
Okay, so that positive gap suggests investment income should continue to climb as the portfolio turns over.
That's the expectation, yes. A built-in tailwind for future earnings growth there.
All right, let's look at the balance sheet and capital position. How's that shaping up?
Very strong. Stockholders' equity grew by over $500 million. That's 6.2%. to a record $8.9 billion.
And book value per share growth.
Before factoring in dividends and any share buybacks, book value per share grew by 7.1% just in the quarter. Pretty solid.
Balance sheet liquidity.
Looks robust. Over $1.9 billion in cash and cash equivalents.
What about debt, leverage?
Financial leverage is actually at a multi-decade low.
Yeah.
24.2%.
Very low. Any near-term debt worries?
Nope. No significant debt maturities until way out in 2037. So a very clean debt profile.
Gives them a lot of flexibility. And the tax rate?
Effective tax rate for Q1 was 22.5%. They expect it to be around 23%, give or take, for the full year 2025.
Okay, so solid capital, low leverage, good liquidity. Sounds like a fortress balance sheet.
Pretty much sums it up, yeah.
Strategically, then, what was the main message from management?
They really hammered home the resilience of their business model.
Yeah.
In this volatile world, economic uncertainty, geopolitical stuff, cats.
Right. Lots going on.
Their focus remains on long-term value creation. They talk about taking steps forward, but just as importantly, avoiding steps backward. Risk management is key.
And their view on the rate environment. Are prices adequate?
Generally, yes. They seem to view the rate environment as adequate enough to support continued growth while maintaining profitability.
So the outlook for the rest of the year?
They sounded pretty encouraged about the rest of 2025. Talked about building a solid foundation now for 2026.
Any other strategic nuggets?
Just that they noted, interestingly, an increase in discipline entering the market in certain product lines recently. Maybe seeing some frothiness and pulling back selectively.
Ties back to that stupid award comment, perhaps.
Could well be. Oh, and one more thing, that MS&AD investment.
Ah, yes, the Japanese insurer taking a stake. Any update?
It's moving through the regulatory process. They said it might potentially start or close sometime in May.
And they see that as a growth opportunity.
Definitely. Leveraging MS&ADs, their big global network, could open doors for future growth partnerships.
Okay, so let's pull this together. From an investor perspective, what are the key takeaways from this quarter?
Well, first off, that strong Q1 performance, especially the ROE, despite those big cat losses, it really signals effective risk management. They handle volatility well.
And the underwriting discipline seems clear.
Right. Plus, the record net premiums written, the growth across most segments, it shows they have a healthy market presence and they're executing their strategy successfully.
And the investment income adds another layer of profit growth.
Absolutely. That's a nice tailwind, especially with those higher reinvestment rates providing a sort of built-in boost going forward.
Their cautious approach in some of those hyper-competitive markets, like the professional liability you mentioned.
Yeah, and focusing on specialty niches in workers' comp, it really shows they're prioritizing profitable growth, not just grabbing market share at any cost.
Which investors generally like to see long-term.
For sure. And keeping an eye on things like tariffs shows they're proactive about potential future bumps in the road.
And finally, that balance sheet. Low leverage, strong capital. It just provides a huge amount of flexibility, doesn't it, for opportunities or just weathering storms.
Exactly. It's a position of strength.
Okay, time for our favorite segment. This is not financial advice, where we kick around some, let's say, creative, but maybe, just maybe, plausible trade ideas.
Always fun.
Yeah.
What have you got cooking this time?
All right, idea number one. Let's call it the geopolitical jitters hedge.
Okay, I'm listening.
So the world feels pretty volatile, right? Political stuff, economic worries, natural disasters. W.R. Berkley keeps talking about risk-adjusted returns, navigating this environment.
They do. It's central to their message.
So consider this. Go long W.R. Berkley stock. They seem good at managing the chaos, but hedge the big unpredictable event risk.
Wow.
Pair the long WRB position with a long position in catastrophe bonds, but specifically cat bonds focused on regions outside of California, given that was their big hit this quarter.
Interesting. So you leverage WRB's operational strength, but hedge the single event outlier risk geographically.
Exactly. Plus, maybe those jitters actually drive up reinsurance pricing generally, which could benefit WRB anyway. It's a play on their resilience and a specific risk offset.
Okay, I can see the logic, even if it's a bit complex to execute. Outrageous but plausible fits the bill. What's idea number two?
Idea two, the stupid award short.
Based on their transactional liability comments.
Precisely. Management was pretty blunt about what they see as irrational pricing there. So the idea is, find a publicly traded company, if one exists, that is heavily, maybe overly concentrated in underwriting transactional liability.
Okay, a specialist in that area.
Right. And if you can see signs that their combined ratios in that specific line are starting to deteriorate, maybe you consider a small, very targeted short position against them.
Wow, that's niche. Betting against what WRB's management basically called dumb underwriting.
It's contrarian, definitely high risk. You're betting WRB is right and that niche market is about to see some pain. But if they are right,
the unwind could be profitable for the short seller. Okay, another one that fits the outrageous but plausible category requires some serious digging to find the right target, though.
Absolutely. Just food for thought. And that brings us to the end of our deep dive on W.R. Berkley's latest earnings call.
We've hit the key numbers, the management commentary, potential signals for the future.
And hopefully giving you a clearer picture than just reading the press release. Understanding these nuances, we think, really gives you an edge.
So what stood out to you listening in? What questions are still rattling around?
We always encourage you to do your own thinking, your own research.
Definitely. Join us next time on Talk Tickers. We'll be breaking down another important earnings report.
But before we go,
Right. Disclaimer. Please remember this was not financial advice. The trade ideas we discussed are purely for illustrative and discussion purposes. Don't act on them without doing thorough independent research and speaking with a qualified financial advisor.